Happy Wednesday, everybody. Is it happy after what happened in the markets today? Welcome to Talkenomics Live. I'm Adam Shapiro. It's great to see you, and thank you for joining us. We got a lot in store for you. Don't forget, we're streaming across several platforms. You get to ask our guests questions. You can do that on X. You can do that on YouTube. Just make sure that you get into the chat, ask your question. We also have a link if you want to appear on the program and ask them questions live. You can do that as well. I'll keep reminding people about that. But let's talk about what happened in the markets today. I haven't seen numbers this depressing since my SAT scores over 30 years ago. But here's what happened. We had the Dow off, 1.7%. The S&P 500 was down 2.2%, lost 120 points. And the NASDAQ was down over 3%. A lot of bad news for NVIDIA today. I mean, the $5.5 billion charge they're going to take selling chips into China because of tariff turmoil. We're going to get to that in a second. But then there was the sweet message from Jerome Powell. You know, nothing like being the chairman of the Federal Reserve and able to destroy everybody's retirement funds with just a few comments about waiting for greater clarity. It sounds so calm. He was speaking to the Economic Club of Chicago, but it was this comment that he made talking about the need for waiting to see if there's going to be higher inflation and slower growth. And he said, we may find ourselves in the challenging scenario in which our dual mandate goals are in tension. In English, well, I can't say that word even though it's a strain because we don't use the F word, but we are, it seems, in the words of the Fed chair, well, we're going to have to wait for us to get through the tension. So what do you do in this kind of situation? That's where we're going to bring in our first guest. You know him well if you cover not only ETFs, but these days, cryptocurrency and Bitcoin. It's a pleasure to have Matt Hougan joining us. He is the CIO of Bitwise. He is also someone who is no stranger to what is happening in markets, having covered them since the late 1990s. He's been involved in all of this. But now he is the voice that a lot of people turn to when it comes to cryptocurrency. And again, Matt, pleasure to join us. Pleasure to have you here. I hope things are good in San Francisco.
Things are well. It's wonderful to be here. Thanks for having me on.
Before I get to reaction to what's going on here, yesterday you made a claim about where Bitcoin is headed. And I sat back and thought, what a fool I was back, 10, 15 years ago when I was at Fox and could have bought Bitcoin. At one point it was $30. At one point it had fallen to $2. And I didn't do it because I thought it was going away. Please reiterate where you said Bitcoin will be at the end of the year. And then help, as Ricky Ricardo would say, explain that one to me.
Yeah, I don't know. That $2 entry point would have looked pretty good at the end of the year. I think Bitcoin's going up to $200,000 this year. So you would have been sitting pretty. The reason for that, I mean, the fundamental reason for that is I think there's a demand supply mismatch in Bitcoin. Bitcoin is growing up as an institutional asset. It's being vacuumed up by institutional investors, by corporations, and also by governments. There's just not that much Bitcoin to go around. But where I see this prediction looking real in the market, the way I can explain it to you, is this is the first major market pullback in history where Bitcoin has outperformed the equity index. If you go back to 2022, during that market pullback, Bitcoin was 3x on the downside of equities. If you go back to 2018, Bitcoin was a multiple of the pullback we saw in the S&P 500. This time, it's basically keeping pace depending on when you measure the start and stop of this pullback. It may be outperforming. That tells me that there's a sustained fundamental bid for Bitcoin. And if we can get some normalization in these markets, I know that's a big if. We'll dig into when that might happen. But if we can get some normalization in these markets, I think that persistent bid is going to drive it back up to new all-time highs at 109. And then above that, and the next place I think it stops is 200K. I think we're going to get there by the end of the year.
All right. Well, I know my brother, I have two older brothers, and my middle brother's probably smiling at that news because he bought Bitcoin a long time ago, not at $2, but he's got some Bitcoin. But let me ask you this. We just had Bitcoin. We just pulled the chart up. It's at 84,000 right now. And it was at 100,000 not too long ago, but a lot of people kind of let go of that position. And so what I hear you saying is, all right, 84,000 for a lot of people is a lot of change. But it would be a great return if it hits the 200,000 mark you're saying. As a novice here, what percentage do you have that you're going to be right on that? 50%, 60%, or 100%?
Oh, it's definitely not 100%. There are scenarios where the world enters a really challenging, sustained economic downturn and risk assets are downward weighted. There's a scenario where Jerome Powell actually drives us into a wall and doesn't play chicken and support the economy that would make that difficult. So, I wouldn't make the prediction if I didn't think it was north of 50, but it's definitely not 100. There's nothing certain under the sun. I will say I'm very confident that you're going to see a decoupling between Bitcoin and stocks over the next year. I think Bitcoin will strongly outperform the S&P 500 as it has in most years in its history. There's just a persistent secular bull market in Bitcoin, and I don't think there's anything about tariffs that's going to stop that. So north of 50, shy of 100.
Okay, so my dad, who was his undergraduate degree he was an economist, but he never practiced it. But he used to say when people talk about hedging before cryptocurrencies were around, he would talk about gold, and he would say the problem with gold is you can't eat it. So we have gold now. It crossed over $3,300, highest point ever. It's expected to go even higher. Why would you choose Bitcoin over gold as a hedge? Because for those of us, again, who are novices, there's a lot of fear when it comes to cryptocurrencies and Bitcoin.
Yeah, absolutely. It depends on what you want to do with your portfolio. When you add gold to a portfolio, what you do is you keep the same return, but you lower your risk. When you add Bitcoin to your portfolio, you keep the same level of volatility, but you increase your returns. There's sort of two sides of the spectrum. When I think about it as a hedge, you know the old saying about gold, an ounce of gold has bought a good man's suit for the last 1,000 years, and it'll probably buy a good man's suit for the next 1,000 years. It holds its value versus physical goods. The problem with using that as a hedge in a portfolio, and I love gold, is if you put 5% gold into your portfolio, you've hedged 5% of your portfolio. What about the other 95%? The beauty of Bitcoin, because it's emerging as a store of value asset, the same way gold did for what it's worth in the 1970s when we got off the gold standard, and you saw it went from $35 to $800. Bitcoin is in that same emergent phenomenon. Is you could add 2, 3, 4% Bitcoin to your portfolio and hedge the entire thing against the fiat debasement, excess debt, and loss of institutional trust that we're seeing in the market. So it's just a very efficient tool long term. Short term, less so. Long term, it's held up extraordinarily well over any multi-year period you look at.
All right, I just want to let the 300 people watching on X and the others on YouTube and Rumble and LinkedIn and Facebook, you can ask Matt questions about the things we are talking about. Just get into the chat and put your question in. I'll make sure we get there. One of the questions I have when it comes to Bitcoin is what impact would there be if the United States decides to, as President Trump has talked about, create this kind of, I don't even know the right nomenclature for it, but a Bitcoin reserve or a cryptocurrency reserve that would propel prices up, or would it have a different effect?
Oh, that would propel prices up significantly and fast. And here's why. The U.S. already created a strategic Bitcoin reserve. It holds the Bitcoin that the government has held for about 10 years, that it seized in the very early days of Bitcoin, holds 200,000 Bitcoin. But the White House executive order on that said that the Treasury shall find ways to add Bitcoin to its portfolio. If the U.S. government starts aggressively buying Bitcoin, what do you think other governments around the world are going to do? I think there will be a cascade of purchases by, dozens of countries around the world rushing to build their position in gold for the digital age. And that would drive prices, perhaps above my target, significantly. So I would note, it sounds crazy, but the US government owns a whole lot of gold. If you look at the store value market, the hard currency market, Bitcoin is $2 trillion, gold is $20 trillion. If you're 100% gold, 0% Bitcoin, you're not holding the market portfolio, right? You need to be at least 10% Bitcoin just to match what the global market is saying the store of value market is. So I don't think it's far-fetched at all for the US and, again, dozens of other countries around the world to start acquiring Bitcoin. It is gold for the digital age. We're moving into a digital world. I think it's going to happen, and it'll contribute to pushing prices higher.
What are the warnings or the triggers that if I'm an investor and I'm willing to part with 85 grand right now, that I should look for to know if the government, if the Treasury follows through on what the president has ordered? Would it be some kind of public announcement, or would it happen quietly? And what should I look for as an investor to figure out, oh, it's happening?
Yeah, I think it would probably be public. I think they would be public about it, or you could trace the wallets, or you would see some activity. There may even be a piece of legislation that passes through Congress that requires the government to do this. There is a piece of legislation at Congress that would have them acquire, 1 million Bitcoin over a period of a number of years. So I think you'll be able to see it. I think you'll be able to know. But what I would really watch is, can it keep outperforming equities as equities fall? If we see continued volatility, but Bitcoin holds above its previous all-time high at 72,000, it's just an extraordinary show of strength. And it tells you clearly, in my mind, that once the broader market stabilizes, this thing is back up to all-time highs and beyond.
We have a question for you, and it's coming from a viewer on X. What happens to the top 100 altcoins if Bitcoin heads north of 250K?
It's a great question. Look, I think we're entering a fundamental era of crypto. It used to be true that crypto had a broad market beta. If Bitcoin rose, then a few months later, Ethereum would go up, and then a few months later, other altcoins would go up, and you just sort of move out the risk spectrum, and you'd see all tides rise. I think that was from a time when crypto was primarily speculative. I think we're moving into an era where crypto is primarily fundamentally driven. Bitcoin is being driven by the fundamentals of institutions, corporations, and governments acquiring it. What will happen to the other 100 altcoins depends on what we see from the fundamental activity in that space. Will Ethereum do well? It depends on how fast stablecoins and real-world assets grow. Will Solana do well? It depends on how that competes with Ethereum. I think you're going to see a wide dispersion of returns amongst those top 100 assets. I would even bet that 70 of them will trend towards zero, and maybe 20 of them will do okay. And then there'll be a handful that return multiples of where they are today. That's the market that I expect to see over the next couple of years.
All right. Just want to reiterate that Matt is calling for Bitcoin $200,000 end of the year. We will take more questions for Matt, but I want to just take a quick breather and turn the subject to one other thing. Tomorrow morning, tomorrow we get Taiwan Semiconductor is reporting, and Angelo Zeno is a analyst at CFRA. I interviewed him. I want to play roughly 1 minute sound bite of him talking about what he's expecting, because the Mag 7 stocks are taking the S&P down. And I want to get Matt's opinion on this because while he's a crypto expert, he understands these markets. So here's Angelo Zeno from CFRA.
Taiwan Semi's got its own set of issues, because if there's a company out there that could really get hit with the tariff side of things, it would be Taiwan Semi. In many respects, when you start thinking about some of the semiconductor tariffs that could be implemented, part of it is to try to get Taiwan Semi to move a lot of that manufacturing production here in the U.S., or at least more of it, so we can have some more leading edge technology here. But maybe to what you're looking for, I mean, we want to see what the state of some of those those leading edge demand is going to look like. What does AI look like right now? What do they have to say as far as kind of the trajectory of AI demand here over the next couple of quarters? Is it sustainable in nature? Do we see some demand being pulled in right now, which could create some uncertainty in the second half of the year? And I do think that is a big concern with the street right now. When you start thinking about the likes of Apple, which is their biggest customer out there, pulling in some of this, or seeing some pull-in effect of demand, you really need the consumer to show up later this year in order for this this pull-in effect to really work itself out.
We were talking about not only Apple, but other companies, $4 trillion market caps. That seems so far off at this point. What Angelo Zeno was saying in regards to what to expect, not only from Taiwan Semiconductor, but the way those once drivers of the S&P 500 are now kind of falling off the cliff, I would think. What's your expectation? What are we going to learn tomorrow, do you think, from them?
Yeah, I think, what I see, again, not an expert in this space, but I think what you see if you zoom out to a 30,000 foot level is rising costs and rising complications due to tariffs, at the same time as we have extraordinary demand at the high end of the semiconductor space. I do think things we've seen in the market, like falling consumer sentiment, would make you worry at the lower end of that space. I bet it's going, if I had to guess, again, not an expert in this space, a mixed report. But long term, looking out a year, 2 years, 3 years, it's hard to imagine anything but sustained demand across this spectrum. I do think the equity markets are broadly going to be messy for the foreseeable future. There's a lot more risk and uncertainty in the market, and you're going to start to see things like United Airlines with its two-tier earnings approach. I think it's just so complex in those markets, it's hard to know what to expect.
When you talk about the complexity, does that make the things like Bitcoin and cryptocurrencies, even though some of us are old school novices, that much more attractive because it's not that complex?
I think Bitcoin's simplicity and reliability is a huge selling point right now. Anytime you have idiosyncratic individuals monkeying with the economy, I think people look to the simplicity of Bitcoin. Even Jerome Powell, we're hanging on his every word. That's sort of weird. And when you pair that with what's going on in tariffs, absolutely, I think it drives people into Bitcoin. Bitcoin is a hedge against that uncertainty and that level of economic meddling. So I do think on the margin, it makes the case better.
All right, as we get ready to go to break, a reminder, you can ask Matt questions. You can ask him about Bitcoin. You can ask him about his thoughts on any of these situations regarding cryptocurrency. And our next guest, I'm going to give you a quick tease here. Unleash Your Financial Superpower. This is the book that Greg Luken wrote. He is going to join us after the commercial break, and we're going to be talking about not only ways to create wealth, but in kind of volatile markets, how to preserve the wealth. Greg Luken is joining us right after the break. So a lot of us are preoccupied with not only creating wealth, but also maintaining the wealth that we have created, especially when you get into your late 40s and your 50s and you see markets doing what they're doing right now. You kind of go, OMG, what next? Well, here's the latest book, Unleash Your Financial Superpowers. And this is written by Greg Luken, who is a financial manager, someone I met years ago when I was at Fox News. He is also the founder of Luken Wealth Management, I believe in Nashville, Tennessee. Greg, come on into the live stream. It's great to see you again. You're in Nashville, aren't you?
We are. Great to see you, Adam.
And Matt's going to take part in this, but I want to start off first with you, Greg. I want to talk about some of the concepts in the book. And the very first thing I want to bring up is you talk about the 7 deadly villains of, I would call it financial security. And we made a quick chart to show people what those villains are. So if we can pull that up, they are the evil clock, the lever denier, the financial porn. This I loved, fin porn, because when I was at Yahoo and at Fox Business, put up a chart, make people think you know what you're talking about. So that's fin porn. The Jones Brothers, that's the hitch over the head with those of us who follow Warren Buffett's advice about index fund investing, passive investing, beware. Brother Dow, market math, and your brain on money. I remember those ads, your brain on crack and all of that stuff. So we're going to talk about all of that. But what is the key message, Greg, that you want to get across to people with this book?
The key message is that making money is one thing, and that's great. But being able to maintain it, multiply it, and enjoy it is something different. What we have found is that research shows that about 79% of millionaires didn't inherit a dime. And this first generation wealthy, what we call first gen wealth, people who made it themselves, have a different mindset. There are all kinds of things that befall them. They get the Waffle House hash brown life and FOMO and imposter syndrome. So there are a lot of psychological things to overcome. But what we have found and research shows is that those people who are successful, there are common patterns that are repeated over and over.
Uh, Let me just jump to what you just said, and then I want Matt to jump in afterward. What are the patterns? Can you just give me a few, heads up about those patterns we would all want to repeat?
Sure. I think the simple way to do it is the three superpowers are really the inverse of the patterns of failure. And the patterns of failure are the lack of a clear, compelling, magnetic vision of the future, the lack of a step-by-step concrete plan, and the lack of consistent execution. So the superpowers are the power of purpose, the power of plan, and the power of executing. And we see those patterns played out time and again.
Greg, or rather, Matt, you want to ask Greg a question about the book?
Yeah, I love it. I would love to know on the flip side, what are the biggest mistakes people make once they make this money to lose it or fumble it? What happens?
Yes. So one of the things that we see as a very clear distinction is it is typically mindset mistakes. How much can you spend? How do you invest? How much risk do you take? Those are really the big mistakes. How many people do you know that they sold their company, they get a big chunk of money, and there is this temporary wealth effect, and they buy the car, they buy the plane, they buy the boat, whatever that is. Other events happen, they make a few investments that don't turn out, and next thing you know, they're not at the same place. Shockingly, about 1 in 3 decamillionaires, people with a 10 million net worth, will not still be there in 10 years. And we recently did research on the Forbes 400 list, and looked at it from 10 years ago. And there is about 44% of the people that were on it 10 years ago are not on it today. Now, some of those have passed. Some who has wealth that has stayed steady, even though asset prices have gone up, and some have declined precipitously. So you think about it, even billionaires aren't immune from this.
I would love the ability to just say I was on the Forbes 400, even if it was just for a week, just to experience what that would be like. I'm more like on the Forbes 10 trillion. Let me ask you this, Greg. I want to pull a quote from the book, because as we watch these markets go up and down, I keep hearing colleagues on financial news networks and people on just regular news networks talking about, well, the S&P 500 recovered. It never recovers the way people interpret that word. And you point out in the book, the larger the loss, the greater the subsequent recovery must be to break even. Very simply, if you lose 20%, you need 25 to 30% to get back to where you were. And in this current market, that's going to be hard. So this would be one of those mistakes a lot of us make as to why we don't diversify, or taking that knowledge that you have. How do I prepare for that?
Right. And so in markets like this, like Matt was talking in the last block, it's important to have some hedging. And so you can use alternative assets, you can use an alternative approach to existing assets, or you can use derivatives to hedge, whether you're doing buffered ETFs to, while it limits the upside, certainly limits the downside, or covered call strategies, which they help mitigate the downside and also create income that can be reinvested. But using those strategies, and what happens a lot of times when people see those declines, then they begin stretching on risk to try to get back to even. And sometimes that's not the time they need to be stretching on risk.
Matt, when we talk about stretching on risk and using crypto as part of this, because again, a novice when it comes to Bitcoin and crypto, but in the traditional sense of investing and maintaining wealth, how would you use a crypto strategy in the way that Greg is talking?
Yeah, I think the place crypto plays a role in that is in a small focused allocation. The biggest risk in crypto, honestly, is one that we're sort of pointing towards, which is behavioral risk. It's adding too much and chasing prices when they go up. and then panicking and selling at the bottom. More wealth has been lost in crypto doing that than in anything else. So when we talk to people about the value of crypto in a diversified portfolio, we're really focused on people allocating 1 to 5% of their wealth to crypto and rebalancing that on a regular basis. And if you do that, there's a possibility you will not make money, of course, in any investment there is, but you're constraining that risk. So again, I think a lot about behavioral risk when I think about maintaining wealth. And the way to treat crypto is not as something you can't touch, but something that fits in a certain place in your portfolio. But for most people, certainly isn't, 30, 40, 50% of their portfolio because it is so volatile.
Greg, part of the book talks about the psychological aspects of these things. And I think we had a discussion at Fox years ago because my brother talks about this. The expectations you hit upon this is once you've made this amount of money, if some people will spend money thinking it's going to bring them joy, and it does for 30 seconds, but then you've raised your expectations. We have a guest who wants to ask you a question, Greg. So we're going to bring a viewer in to do that. And go ahead. You are live on Talkenomics Live.
Thank you, Adam. First of all, Matt, that was a great question you asked Greg, and I'm not too sure my question is going to beat it, but here goes. Greg, what are the top 3 indicators that you and your team rely on to begin repositioning your clients' investment assets?
Yeah, that's a great question. Because we are a quantitative technical shop, we use quantitative indicators. So we use a momentum indicator, how something is doing relative, for example, how Bitcoin is doing relative to the S&P 500 or to the bond index. We also use what we call a mean reversion indicator. And if you think about there being kind of a rubber band on asset prices, if they go up too far too fast, they snap back down. If they go down too far too fast, they tend to snap back up around a trend line. And we generally use a 31-week and a 31-day exponential moving average to help us establish those ranges. And then we use a directional strength indicator, which is really a supply and demand indicator. It measures speed and magnitude of price moves relative to time. So,
when you're talking to your clients about what you've just described, do they glaze over? Do they understand what? Okay, so how do you make someone like me understand what you just said? Because I want to follow your advice. I know you're successful.
The easy way I think to describe it is markets have some patterns that recur, not because Bitcoin is the same as the S&P 500 as the emerging markets index, but because human beings are involved. And so the technical indicators are really a way to measure how people tend to behave. So for example, we know where we are right now with a lot of technology stocks, with the S&P, with the NASDAQ 100. We are at a tipping point where if they go down another 3%, there will be panic that sets in. And you saw that a couple of weeks ago with trading volumes, spiking at 4 and 5x. And that is a sign that human beings are voting with their pocketbook. And so we simply construct indicators that say, how are people probably going to behave, often poorly, in these scenarios?
That's kind of like riding the subway in New York. Stu, do you have a follow-up question, or shall I go to Matt? Because I have a question for Matt if you don't.
No, I don't. Thank you, Adam.
And Stu, we appreciate your being here. Thank you very much
for having me.
Talkenomics Live. Matt, I want to ask you about this risk that and fear factor that Greg just brought up, which is the panic element. My whole experience investing since the late 1990s up until now has been be patient, be calm. And I go through the panicky fear stuff that everyone has, but this time feels different because of the tariff uncertainty, because the global economic rules are over. They've changed. So how do you adjust right now without understanding where any of this could be going?
Yeah, I think it's really challenging. I do think that, I mean, this time is different. It's always difficult to mutter those words and be right, right? And certainly COVID felt different, and the global financial crisis felt different. And I know I more regret the trading actions I took around the GFC and around COVID than I do look back on them fondly. So my starting point would be to do nothing. But I do think it's reasonable for people to, to at least have a buffer of confidence and have some dry powder available to them that lets them sleep at night. Maybe if they think about 80-20ing or 90-10ing their portfolio and staying the course with the majority of what they're doing. But if they feel the need to scratch the behavioral itch, doing that in a small way that raises some fresh capital that they could deploy at lower levels, I think that's completely reasonable. But the old saying is, don't do something, just stand there. Is I think a reasonable comment. That was one of Jack Bogle's favorite phrases, and I think it's generally served people right. But if you have to fiddle at the margin to make yourself sleep at night, I think that's okay as well. Just don't take wild swings. This is not the time, in my opinion, to do that, because there is so much uncertainty on both sides.
Greg, what are your clients? I mean, there is fear out there. What are they, when they call you, what kind of things are you hearing them say?
Well, I think the same kind of things any rational person who has had the news on, in the last 3 months would say. People are concerned. There is a lot of uncertainty. One of the things that we fall back to is, when in doubt, don't get out. And that having that bias to stay invested, to stay long, has served well. I like what Matt said. That's actually what we do. We have a strategic part of the portfolio and using a dynamic part, so that the human brain craves activity in times of stress. Well, somebody needs to do something. And so the question is, how do we do something? And the truth of the matter is, if we're all honest, everybody's a market timer. The S&P 500 committee times the market. They don't include all the stocks, right?
Right.
And if we have cash in our checking account today, we're probably timing the market, saying, I'm going to wait to put that in my account and invest it. So we all make some timing decisions. The question is, how are we doing that? Do we have a process that gives us some probability of success?
So, Greg, last question for you, and it's a quote from the book which I loved, and it comes in when you're talking about fin porn, because having worked in traditional media, I know even at Bloomberg, at CNBC, they will throw up a chart sometimes, and it has some value to it, but the people creating the chart may not totally understand it. But hey, it looks good because it's got lots of numbers. And you talk about fin porn, and you talk about, I think it was a Nobel-winning economist who wrote in the 1980s a book. And here's the quote: "I've kept a book in my office as a reminder for several decades." Quote, "The book is about surviving the coming Great Depression that will, without a doubt, occur in 1988 or 1989. Still waiting." That when I read that and I hear you say, panic, 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 hurry up and do nothing, I think you're addressing this issue about a very smart individual who predicted a depression which never came.
Yes, and it's I would make the distinction. It's okay to be educated. It's great to be educated. It's great to watch things, but to get to a point where you get all stirred up, and there's a perversion of the knowledge that it's not really serving you, and that's what we call fin porn. I think it's great to consume financial media and understand more what's going on, but when it gets you wrapped around the axle and gets you stirred up about making bad decisions, it's time to stop that addiction.
All right. The book, once again, is Unleash Your Financial Superpowers by Greg Luken. We're going to take a quick break. When we come back, we're going to take a look at the other big report that's coming out tomorrow. That's Netflix. I know you're watching something on the streaming service, but are you watching the price target? Well over $1,100. They're not there yet, but they're heading there. We're going to hit that after the break. All right, Netflix earnings are on deck. They're going to report, they say, after the bell tomorrow, but we're going into a holiday weekend. Maybe they should move that up and just surprise everyone, report before the bell. But the good news is I had an interview with Ken Leon, the Global Research Director at CFRA, and we talked about what to expect from Netflix, and here's some of what he shared with us.
The core business of Netflix, and it's a business that was established over 20 years ago, is the ability to drive subscribers. Just in the fourth quarter, they added just under 19 million net subscribers. They have 302 million subscribers. We're looking ahead for 15% revenue growth from that contribution of subscribers. Last year, they began to look at advertising revenue and also introduced a more affordable ad pay plan versus ad free. It's working well. We're going to begin to get some financial numbers in those two categories this year, but it's still small relative to their traditional business, which is ad free subscriber base.
So what I heard you say, though, is that one, subscribers are willing to have a hybrid, I'll pay, but I'll suffer through some advertising. And two, that's still a relatively small portion of I think the anticipated revenue is something like 10.4 billion. It's nowhere near a driver of their revenue, is it?
It really works well for Netflix because we have in the US the ad-free premium ultra high def plan is now $25. The ad pay plans are under $10. And so it gets to the issue of affordability. I think if there's cord cutting, plus also reducing the number of streaming providers, nobody's cutting Netflix. And then when we look to the rest of the world, because the monthly rate plan or the average revenue per user is different and much lower, particularly in developing markets in Asia like India and Latin America. So I think it's a win-win for Netflix. They're really exceptionally positioned.
What about the cost of competing for live sporting events or live concerts and just the enormous cost of producing content when you're only going to get 8 to 10 episodes in a series? Are they still on top of that?
Yeah, so we saw last year the NFL games that they were able to produce, I believe Christmas time, it's been a while, but also they signed a multi-year, multi-billion-dollar contract with the WWE, Worldwide Enterprise Wrestling Enterprises, that looks to be an opportunity for Netflix to extend that brand outside the US. Keep in mind this, that since I've been covering Netflix for many years, they've been very cost disciplined on producing programming and entertainment content, about $17 billion. So I like to think about things like the NFL as a toe in the water. They're not going to get into the crazy situation of bidding for the large size NFL sports rights or NBA. So they're going to be smart about it. Now, where they've been successful and have really outpaced anyone is sports documentaries, the ability to play off of some of the leagues I've just mentioned and profile different stories. They've done it across those sports, plus tennis and golf and Formula One.
When he was talking, I kept hearing in my head that song from when all of us were kids, Video Killed the Radio Star. And I kept thinking streaming has killed the industry that made my career possible, which is linear television. I mean, when you think about the price target right now, Matt, on Netflix, depending who you ask, is anywhere from $1,100 to $1,200. Ken is saying $1,125. It just seems... I don't know what drives some of these metrics sometimes, but it just seems like things are so expensive, and yet people watch the shows.
Yeah, it's funny. It's funny that that's what ran through your head of Video Killing the Radio Star. What was running through my head was user-generated content and whether Netflix can survive in an era where streamers are maybe taking over in terms of the share of media that I consume. Yeah, exactly. When I think about my own media consumption, it is shifting more to direct streamed content from people in the field than it is to produced content. But maybe that's just an N of one. It's hard to look at that chart and be anything but bullish. I've definitely heard the previews. But I don't know. 10 years from now, are we all still primarily consuming produced content in a streaming format? I don't know, but that is a beautiful chart. I would say that.
Yeah, Greg, what about you? I mean, I consider myself old school. I think you've got a company, you produce something people want, they buy it, you're public, you trade it. But streaming and the ability to do a program like this really does undermine content creation as we understand it. I mean, you understand finance matters.
It absolutely does. Technology has really created a democratization of so many industries, including the media. I do think that we don't buy individual stocks, but I did plug it into our indicators. It looks really solid. Our directional strength indicator looks good. $931 a share seems to be that really critical price, and you see a lot of battling between the bulls and the bears when it gets down there. That's the critical level. I think if somebody said, "Hey, I have to own this," I would do that, and I would watch it like a hawk at 930 if it gets back to $931 a share.
Let me throw this out to both of you. There was the story years ago, and I forget who it was, but the famous investor who followed his daughter in a mall. That's how old this is, because who goes to a mall anymore? And looked at what those teenage girls were doing and what they were buying, and then went and bought stock in the companies from what those teenagers were doing. Can you do that kind of thing? I'm going to throw it to you, Matt. Can you do that kind of thing today the way the let's say a 35 and under crowd is consuming media?
Yeah, I got 3 kids. I was thinking about that. They're on YouTube much more than Netflix. I'm not sure they have any brand affinity to Netflix versus Hulu versus whatnot. Peacock, I don't even know that. I couldn't even tell you which I'm subscribed to. I just turn on the TV. I'm not sure how it works. So I do think there's an element of truth there. I do think the media landscape may be shifting. Now, Netflix, has evolved with multiple media transitions. So it's one of the best run companies in the history of the world. I wouldn't short its ability, but I do think the media landscape is changing, and that's an important thing to keep in mind.
Greg, we're watching. I think it's called Prime Target on Apple TV, which is it's a great thriller if you're into prime numbers and that kind of stuff. Are you watching anything you'd be willing to share with us right now?
Yes, we just got through watching the latest episode of Bosch Legacy.
Okay, so let's wrap this up. Let's wrap all of this up. I'm going to give closing comment first to Greg and then to Matt. Greg, we've talked about your book, Creating Wealth, Maintaining Wealth. You heard Matt in the first part of the program talking about Bitcoin and possibly going to $200,000 by the end of the year. What is it you want people to leave Talkenomics Live tonight knowing? I'm sorry, Greg.
Oh, sure. Knowing that if you focus on running your own race, managing to your own index, that we've just seen people have great lives by doing that, as opposed to following the villains down the path of envy.
The 7 deadly villains in your book, that they alone make it worth buying the book. Matt, what about you? What is it you would like people to take away? And I will make sure that we include this when we cut up for social media postings. Your thoughts?
Yeah, I would on the Bitcoin specific thing, I would say that Bitcoin today is a very different asset than it was when it was $2 back when you first considered it. It's really emerged as an institutional asset with ETF wrappers that are being bought by pension funds, endowments, and indeed countries. And if you haven't looked at it, I would look at it afresh, of still very volatile, but I would argue very interesting. So it's worth considering.
All right. And we're all still breathing. We're all still standing despite Jerome Powell, despite an almost 700-point drop in the Dow. And we didn't even talk about the villains of the indexes with Greg, but make sure you get his book. I appreciate both of you joining us this evening on Talkenomics Live. And next week, we're going to see if we have some recovery, because it won't be a complete recovery unless we have some kind of dramatic 40% gain, some recovery in the markets. And we will be back with you live 7 p.m. Wednesday, live from Brooklyn, New York on Talkenomics. Have a great week, everybody.
Thanks so much.
Amazing. Great show. Great show.
Both of you, thank you. I really appreciate your sticking around for the full show.